Now we're going to take a look at the reversal strategy. Now, the reversal strategy is designed around reversal divergence, and it's been designed to trade end of trend and also the end of phase 2. It's something that can sometimes give us a phase 2 trade, but can sometimes give us a complete change in trend and give us big winning trades. And it's broken down in two parts. There's a first take profit that's designed to give it a high success rate, and then there's also the second part of the trade that uses a trailing stop loss, which is designed to let the trade run and lock in those big wins. It's designed off of the daily charts, so we're only taking signals off the daily charts to be classified as the true reversal strategy. It does, however, work on time frames such as the hourly, 4-hourly and weekly charts as well. I've just highlighted on this euro-dollar daily chart some of the reversal divergence setups that have occurred over the past year. So we're looking at 2012 here, and I've got some of these reversal divergences marked on the charts. We can see here we've actually got ourselves a lower low in the price action and a higher low on the stochastic oscillator. We're going to zoom in here and look at this in more detail, because as with reversal divergence, the reversal strategy actually needs to definitively see the %K, which is the blue line of the stochastic, which is the first line, flick in the direction we're looking to trade. Now, lower lows in price action, higher lows on the oscillator, and we're looking for a buy signal. So we must wait for the blue line to flick to the upside. And as we look at that, we can see it actually happened on the close of this small little inside bar at the absolute end of the market's movement. So if we just focus now on this small little inside bullish candle, we set the trade up in two parts. Of course, we're going to have our entry level to begin with. We're going to mark our entry level in blue. And our entry level is 2 pips above the high of the bar if you're buying. So we know that this is a reversal divergence, and the %K, the blue line, is flicked to the upside. We're looking to enter 2 pips above the high of the bar or the candle that actually gives that flick to the upside. Our stop loss goes to the lowest low of the last 3 bars. 1, 2, 3. We can see this bearish candle here is the lowest low of the last 3. So we put our stop loss underneath there, and we're just going to highlight that in red so we can identify where we're going to put our stop loss. And our stop loss actually goes 0.1% of price underneath that level. Now, 0.1% of price sounds particularly complex. However, all you need to do is read the first 2 numbers from the price of the currency. So in this case, the euro dollar at the time was 126, 127-ish. We can see the first 2 numbers, the 1, 2, gives us 12. Now, 0.1% of price should be around 10 pips on the daily chart, and the stop loss is designed to be around 10 pips underneath this swing low. When I say around about 10 pips, I'm talking about 0.1% of price underneath this. If you were trading this on a different time frame, such as the 4-hourly charts, your stop loss would want to be around 7 pips underneath this area. We see here that we've got our stop loss in place and our entry level in place, but there's 2 parts to the trade. The first part is to target the ATR 5, and we take 50% of our trade off at ATR 5. The second part of the trade is to allow it to run, and we'll be moving our stop loss. If we address with the ATR 5 to begin with, we can see down here the ATR 5 for the entry order bar in question. The ATR 5 here is shown as being 0.0133, which is 133 pips. That means we target 133 pips from the entry price, which we can see very clearly was hit within a couple of bars. Bearing in mind this ATR5 is designed to give us a good success rate. The trailed stop loss is designed to give us the big wins. This means for each and every trade, if we assume that we're risking 1% on the entire trade, we must set up 2 orders per trade. The first order has the entry level and the stop loss, and also has the first target. So the entry order 1, which is part of this trade, would have entry, stop loss and target. The second part of the trade would simply have the entry and the stop loss, and it wouldn't have the target because the second part of the trade is the one that we would be trailing. Now of course we can see that this here has triggered us into the position, very nearly hit our first take profit on the first bar, but actually took 2 bars before it got there. You'll find that 80% of the ATR5 part of the trades will hit their targets inside of 1 to 2 bars. It's designed to be a very, very quick take profit. And this of course gives us that higher success rate. Now that we've seen of course that the entry level, the stop loss and the target of the first part of the trade and under the second part of the trade is going to mean actually moving the stop, we need to move our stop loss using the double buyer double seller methodology, which means that we move our stop loss to the lowest low of the last 2 buyer bars, or in this case the last 2 bullish candles. We see bullish candle 1, bullish candle 2, we can move our stop loss ever so slightly underneath that level. Now that this was bullish candle 1, bullish candle 2, this 3 numbers, bullish candle 1, bullish candle 2. And it can get moved again. We can see here, bullish candle, bullish candle. We can actually move our stop loss again now, underneath that level. We've moved it to a position whereby the stop loss is beyond the break-even point. It's a risk-free trade. And that's all by the time the candle closes up here. We have 1 bullish candle followed by a bearish candle. We do nothing. We have 2 bullish candles. Our stop loss is now able to move underneath the lowest low of the last 2 bullish candles because we're buying. And of course it's 0.1% of price. In this case around 13 pips, 12.8, pretty much 13 pips underneath the lowest low of the last 2 bullish candles. Another bullish candle comes along. We're able to move our stop loss once more. We get the next bullish candle, and again we're able to move the stop loss. We can see the reason why we're moving our stop loss using this double buyer bar, double seller bar routine is because we don't want to be too aggressive and get knocked out of the trade on 1 bar pulling back against us. We want to give it room to breathe because our first part of our trade has already banked profit for us. The second part of the trade is designed to breathe and run to lock in the bigger wins. Now we then get ourselves a bearish pin bar here. That means nothing with regards to trading the stop loss. In fact, if we look at this, the open price was 0.5, the close price was 0.7. So this was actually a bullish candle, even though it was a bearish pin bar, but of course the stop loss stays at the same level. We now have another bullish candle through here. We now have another bullish candle through here. We're able to move our stop loss underneath these 2. We then get the bearish candle, which means we do nothing here. We leave our stop loss where it is. And we finally then get stopped out of the trade. And that took us 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, about 11 days, so around 2 weeks, just over 2 weeks to then get knocked out of the trade. The interesting part here is our stop loss was around 75 pips. And the first part of the trade made 133 pips, which was the ATR 5. So a 75 pip stop loss to make 133 pips. That's very nearly a 2-to-1 reward to risk straight away on the first part of the trade. The second part of the trade here actually ran to making around 380 pips of profit from the 75 pip stop, which is around about 5.5% return from the trade. Now, bearing in mind that 5.5% return is actually only running at 0.5% risk. The reason for that, of course, is this trade down here, we deliberately have that split into two parts. Half the trade has already taken profit at this point here. So we're looking at this point here, we had just shy of a 2-to-1 and a 5.5-to-1, which means this bank just underneath a 1% profit at 0.5% risk. And this one banked just about 2.75% profit off of the 0.5% risk. We're looking realistically at about 3.6, 3.7% return from that trade. And that's nice because we've had that first one hit profit very quickly. We're moving our stop loss to reduce our risk and lock in our profits. And if it runs, we're able to actually capture part of that move and lock in the profits as well. As we continue through now, we can now focus on the next reversal divergence, which we can see happens here, where we have the lower high on the stochastic oscillator and the higher high on the price action. We wait for the blue line of the stochastic, the %K, to flick to the downside, and in this case it actually crosses over as well, but the flick over is enough to give us the signal. Now that we've got the signal, we can actually have ourselves our entry level underneath, with our stop loss moving above the highest high of the last 3 days, or the last 3 bars, which works out as this swing high point up here. So we've got ourselves our entry and our stop loss, and bearing in mind our stop loss goes now 0.1% of price behind that high, which is about 13 pips above that swing high there. We haven't actually been triggered into the trade, the order has not been filled, but the %K blue line is still pointing to the downside. We're able to move our entry level to underneath this bearish inside pin bar. Because all of the conditions are still correct for us to have the reversal strategy trade, we've got ourselves with our entry and our stop loss there. The order has now been filled, but bearing in mind, with this order, when you're placing these orders, we have two parts to them. We know that one part, of course, is going to be trailing the stop loss, but of course we need to actually make sure we have our ATR target in place, which on this specific one was 117 pips. We can put our first take profit in place at 117 pips. We can see that's around 115, 160, 117 pips. Our entry, our stop loss, and our first take profit, which is the ATR 5. Of course, we know we're going to trail our stop loss on the second part of the trade. Once this order then gets filled on the close of this candle here, we've not quite hit our first take profit, but we are in a position to move our stop loss. We have bearish candle, bearish candle. We can move that stop loss down and we can reduce our risk. We see now that our first part of the trade has now hit its take profit. So we've banked 117 pips of profit, and we're also able to move our stop loss down because we've got seller candle, so two bearish candles there. We can really reduce our risk. And it's at this point now that we're actually in a position whereby it's a risk-free trade. We've managed to bank ourselves 117 pips, risking 0.5%. We can see that clearly. And we've actually got ourselves into a position where we've got about 40 pips of risk, but we've already banked 117. We can't actually lose on this trade now. And that's a really nice position to be in when you're in a trade that you can't lose on. So we've locked in the first part of the trade. We're trailing the stop loss now, and this bullish pin bar appears. Well, we're actually in the trade. We've got a stop. We don't stand to lose, and we're going to leave the position running until we see another bearish candle or seller bar. We're still holding the position. We're not moving the stop loss, but bearing in mind that part one of the trade has already closed out for a profit. And we get stopped out on the second part here. So we lost around 40 pips on the second part of the trade, but we banked 117 pips on the first part of the trade. Only a small winning trade there, but we can see how using that ATR5 is a great way to turn some of your lower quality trades actually into winning trades. And the reason why we took this trade is because of the reversal divergence. Of course, you never know exactly what's going to happen next, but off of this signal, we actually managed to make some money out of it, which only worked out to be a small phase 2 against the dominant upward trend here. As we keep moving along now, candle by candle, bar by bar, we can start to see another divergence forming. We see the higher highs on the price action, and we see ourselves with lower highs on the oscillator. And it's actually this bearish inside candle up here which gives us the sell signal. We can see that the %K, the blue line of the stochastic, has flicked to the downside and actually given us the signal now. If we go ahead and actually put our entry level underneath there, just a couple of pips is more than enough. So 2 to 3 pips maximum. And our stop loss goes above the swing high here, which is the highest high of the last 3 bars, or in this case the last 3 candles. And as we watch, we see that the next candle comes along, does not trigger the order. So we'd actually cancel the orders, and we'd now place new orders for this next candle. And the reason we're doing that is because the %K blue line is still pointing to the downside. So our entry level is underneath this double inside candle formation. On the smallest inside candle, stop loss above the highest high of the last 3 bars. Now we know that with this, when we're placing our orders, we need to place our first take profit. So for each trade there's 2 parts. There's order 1 and order 2. We know that order 2 just has the entry and the stop loss that we've got shown here, but order 1 needs that first take profit as well. Our first take profit on this order is 105 pips. We'll just mark on 105 pips. We're risking around 115 pips to make 105 pips, which is slightly an inverse reward to risk there, which is a little bit frustrating, but bearing in mind this first part of the order is just designed to give us that high success rate, so it's very difficult to lose money on the trade. We see here that the order's been filled by this engulfing candle. We've been triggered into the trade, and it's running in a profit at present. The first order 1 has not hit its target yet, but we are able to move our stop loss down behind the highest high of the last 2 seller bars because we're selling. We have ourselves another bearish candle here, which looks like it just got to our take profit, but we can't move the stop loss any further because of the fact that there's not another seller bar yet. This is still the highest high of the last 2 sellers. We've definitely hit the first take profit. That's really, really good. And we can now move that stop loss again to the highest high of the last two bearish candles, the last two seller bars. A bullish candle appears and we do nothing. Another bearish candle, and we're able to move the stop loss down to the highest high of the last two seller bars, or the last two bearish candles, plus that 0.1% of price, which is around 13 pips. That's just keeping us safe, putting it behind the highs of the candle there, just to keep us out of harm's way. And we get ourselves another bullish candle here, do nothing. Another bullish candle, do nothing. But we're actually now in a position where we've got ourselves a bearish candle 1, bearish candle 2. We can move that stop loss to the highest high of the last two bearish candles, plus the 13 pips. The trade's completely risk-free. We've hit our first take profit over here somewhere inside of 3 bars, which is nice. Actually, might have even been 2 bars there, which is even better. And we're now running the trade in our favour, looking to lock in additional profits. And we get ourselves another bar up here. This is a bullish bar, do nothing. We get a bearish candle here. We're unable to move the stop loss because it's currently in the correct position. We get ourselves bearish candle, bearish candle. We can move that stop loss down and lock in additional profits. Now we're in an interesting position here because we actually now have a reversal divergence, which is this lower low and the higher low on the oscillator. So the disagreement between price and the oscillator, we've got a reversal divergence saying price is now likely to move to the upside. This reversal divergence actually appeared on this bearish candle here. Now, because we've got a reversal divergence telling us to buy, but we're still in the short, we actually need to get ourselves out the short and get ourselves potentially into the long. So what we'll be doing here is we're moving our stop loss down, and we forget about the 0.1% of price now. We put our stop loss for this short trade to the same level as where we're looking to enter on the long orders. So we put our stop loss down to the entry position of the long trade. Now, of course, we know now that that's actually stopped us out of the position and got us into the long position, which resulted in a profit there of around 280 odd pips, which is a significant profit considering our stop loss was around 110 pips. A positive 2.5 to 1 reward to risk trade, plus of course we banked this first part here at 0.5%. If we look at this next signal, we know that we've been stopped out now and we've been triggered into this long position. We can see the entry level, we can see the stop loss, and our first take profit on this order would have been at 127 pips, which is a little bit further than that. So we can see 127 pips is our first take profit. We know we're definitely in the trade. It's running nicely in our favour. We've had 2 bullish candles. The stop loss of course stays down here because these lows are the same level. On the third candle, we've hit our first take profits. We've locked in a positive reward to risk on this first part of the trade. And we're able to now move the stop loss and reduce the risk on the second part of the trade. Bearing in mind the stop loss is 0.1% of price underneath the lows of the bars here. And we're using the double buyer bar, double seller bar formation of moving our stop. We have a bearish candle appear, so we do nothing. And another bearish candle. And again. And it's not until this bullish candle here that we can now move our stop loss up to underneath this bullish candle. Remember the lowest low of the last 2 bullish candles. The next bullish candle appears. We can now move that stop once more underneath these 2. Again, it's about 13 pips underneath these 2, and we've locked in a profit now. We can't lose on this trade. Seller candle appears and we're going to do nothing. bullish candle appears, and actually we're going to leave the stop loss in the same place, because we can see here, of course, the lowest low of these two bullish candles is where the stop loss already is. Another bearish, another bullish candle. We can now move that stop loss up underneath this little doji bullish candle, and we can lock in a little bit of extra profit. Bearish candle, and we get stopped out. But again, we've managed to rack up 127 pips in the first part of the trade, and also managed to achieve about 175 pips on the second part of the trade. So again, we're looking at positive reward to risk trades there, and bearing in mind that our stop loss on the trade was around about 85 pips. So 85 pips stop loss, and we managed to make around 175 pips on one part of the trade and 127 pips on the first part of the trade. As we progress through from here, we're looking for the next reversal divergence, and I've got it marked on around here. So we can see we've got definite lower lows in the price action. If we zoom into the stochastic, we can see these higher lows on the stochastic here. And it's actually this bullish engulfing candle which gives us the entry signal, or the buy signal. We'll be looking to have ourselves a stop loss underneath this bullish engulfing candle. Our entry point is going to be 2 or 3 pips above the highs there, which we'll mark in the blue. And our first take profit on this is going to be 126 pips. We just mark where that is. We can see it's actually working out as an inverse reward to risk trade to begin with. But again, we're doing this for the success rate to make sure if we hit that first take profit, it's very difficult for us to lose money on the trade. Certainly we can't lose a full 1%. So our stop loss is 165 pips, plus the 12 or 13 pips, which is 0.1% of price. So we're looking at close to 180 pips stop loss. And our first take profit here is about 126 pips. It's definitely inverse reward to risk, but again, we're doing it just for that success rate on the first part of the trade. The second part of the trade, we'll have a trailing stop loss, which we'll manage based on the price action. We've definitely been filled in the order. We're in the trade. There's no need to move the stop loss yet. But now that we've got these two bullish candles, we can actually move the stop loss from this low point to the lowest low of the last two bullish candles and significantly reduce our risk. We haven't quite hit our first take profit yet, but we're still in the position with a strongly reduced risk. We've just hit our first take profit, which is great. So the first take profit has been taken, and since it's been taken, we're now in a position where we can't lose money on the trade. We've banked ourselves these 126 pips or so, yet we're risking around 86 pips. We can't lose on the trade now. We have bullish candle, bullish candle. We get to move the stop loss to the lowest low of these two bullish candles, reducing the risk even further. We know the stop loss is the lowest low of these two bullish candles. And again, all we're doing through here now is reducing our risk, and now we're in a position where we're locking in our profits. We're still in the trade, and we're now able to move our stop loss once more, and we're locking in additional profits as the trade continues in our favour. Still continuing in our favour, still locking in the profits until we get stopped out. So we can see we made the 126 pips here on the first part of the trade, and we've also made ourselves another 96 pips on the second part of the trade. A long way from being a big winning trade, but a winning trade is a winning trade, and while this didn't move strongly in our favour, we still managed to capture some profit. We'll move through now and look at the next opportunity, which we can see here is from the lower lows in the price action we actually have these higher lows in the stochastic if we zoom in slightly, and we can see the blue line of the stochastic, the percent K, has flicked up on this bullish candle. Our stop loss goes to the lowest low of the last 3 bars, and our entry point goes above the bullish candle. The entry point is going to be shown in blue, and the stop loss there is in the red. And our first take profit here is about 107 pips. If we mark the 107 pips on here as well, we can see it's going to be again a slight inverse reward to risk first part of the trade in the interests of getting that higher success rate. We hit our first take profit very, very quickly. So our first order hits take profit and the broker banks the money for us, and we're only managing a 0.5% risk now, and straight away we're able to reduce the risk on the trade by a small amount. As these bullish bars continue in our favour, we get the second part of the trade into an even further reduced risk, and overall on this trade now it's impossible to lose money. We get the 2 bullish candles again and move the stop loss to the lowest low of the last 2 bullish candles, and actually make sure that the second part of this trade, the second order here, is in a profit as well. That's where we then get stopped out, so it seems to be another small winning trade. But we can see here that we're still accumulating these small profits as we go, while we're waiting to get the big profit that runs in our favour. As we continue through here, we can see that it was quite some time before we saw the next signal, which occurred up here. We had the higher highs in the price action, the lower highs in the stochastic, and it was the bearish pin bar, the high bar, where the stochastic gave us the signal. You should know the setup by now, of course, was entry 2 pips underneath the low of this candle. Stop loss about 13 pips above the highs here, which is 0.1% of price on this currency pair at the time. And our first take profit on this order was going to be about 72 pips, which is more than likely was hit on the first day there. So within 1 bar we've hit our first take profit, and we can see that it continued to move in our favour as the market fell to the downside. Now this reversal strategy, this reversal system, is based off of the stochastic oscillator, which is giving the divergence, the ATR5, which is giving us the first take profit, and of course the price action, which is affecting the stochastic and the ATR5 themselves. The step-by-step process is first of all to identify the stochastic divergence and wait for the blue line, which is the percent K, to flick in the direction that we're looking to trade. Once this occurs, place the trade, which of course is 2 orders. Order 1 has an entry, stop loss, and a first take profit there, of course, being the ATR5, and the second order just has the entry and the stop loss. That means that order 1 will get banked by the broker for you when you hit your first ATR5 take profit. And the second order, you then keep managing through, moving the stop loss in the double buyer bar, double seller bar formation until you get stopped out. The only reasons why you'd break from the double buyer bar, double seller bar formation is if you get a signal in the opposite direction. That is, if you have another divergence set up telling you to trade in the opposite direction, go with the latest signal. That means that when the reversal divergence is running in your favour, if you get a continuation divergence stating to trade the opposite direction, or a reversal divergence stating to trade in the opposite direction, you go with the latest divergence setup. That means that your trade could then be moved, and your stop loss could then be moved to get you out of the current trade and potentially into the next one. We always trade the most recent price data on the chart, which means we need to make sure when the latest signal appears, that's the one that we follow. The reversal divergence system, the reversal strategy, is a very, very high success rate strategy thanks to that ATR 5 first take profit. And it's also a positive reward to risk expectancy as well. That means that we're actually in a brilliant position because psychologically we expect to win more than we lose on a percentage basis. In fact, the statistics are typically around the 70 to 80% success rate areas, and we're looking for positive reward to risk from the trades. Of course, this does not happen on every single trade, but we are looking to achieve positive reward to risk on average overall, thanks to the second part of the trade being allowed to run, and actually then lock in the profits and capture the big winners. You can see that for this price action and divergence based strategy, you need to be familiar and comfortable in locating and finding reversal divergences on the charts. Not where they were, but when they actually occur. The best way to do this is to use the trading simulator and actually go through several years worth of data for several currency pairs and actually trade the data itself and trade the signals when they set up. The trading simulator will actually hide away the most recent data and allow you to trade from a date in the past up until the current time. This means that you can get years worth of practice in a fraction of the time and become very comfortable with this reversal system.